I'm Ian Castle, founder of Microcap Club, home to the best microcap stock pickers on the planet. Since 2011, our members have profiled over 1,300 microcap companies, with over 290 turning into multi-baggers. That's more than one big winner every single month for 14 years. If you share the passion for finding great companies early, before Wall Street and the institutions, Microcap Club is where you belong. Join us.
Doing our next stock pitch will be Donangelo Volpe from Beacon Securities.
Hey everyone, my name is Donangelo Volpe, equity research analyst at Beacon Securities. I've spent the last 6 years in the industry. My first 2 years were on the buy side. I've spent the last 4 years at Beacon Securities, 2 years as an associate. Covered basically everything except for energy, and then I made the transition to analyst about 2 years ago. Currently cover about 12 names. Excited to discuss 2 of them with you today. I'll be bucking the trend a little bit. Just in terms of my investment or how I go about investing or picking stocks, I like management teams that are very strong, that are aligned with the investors. I also like clear moats within the industry, and I would like strong valuation compared to peers. In terms of the names I'm talking about today, I just got to disclose we do not have a current banking relationship with them or over the last 12 months, and I do not own either of the names, although I would love to. So the first name we're going to be pitching today is Haivision Systems. The ticker is HAI on the TSX. Can I bring this up bigger? No. So Haivision's a global leader in mission-critical and real-time video streaming infrastructure solutions. They currently service the media and entertainment, enterprise, military, and defense markets. They're a fully integrated one-stop shop provider of video infrastructure solutions with headquarters in Montreal and Chicago, and they also have offices across the Americas, Europe, and Asia. Currently, 2/3 of their revenue are derived from their mission-based customers. These include the U.S. Air Force, U.S. Navy, the U.S. Army, as well as the Department of Homeland Security. And then 1/3 of their revenue is actually derived from their broadcast-based customers. That includes the NFL, MLB, NBA, NHL, ESPN, Warner Bros., and Sony as well. So just in terms of our thesis, we initiated coverage last week with a buy rating and a $7 price target. That's based on a 10.5 times fiscal 26 adjusted EBITDA multiple. Why we're interested in the name, it's currently trading at about 1 time sales and 7.5 times adjusted EBITDA based on our estimates, and we do believe that it provides an excellent risk-reward opportunity for investors. The current valuation is attractive given the potential for the company to reach double-digit growth over the coming years. They've got a strong margin profile with over 70% plus gross margins, and we strongly believe in their potential to reach 20% adjusted EBITDA margins as the company continues to scale. In terms of peers, peers are currently trading at about 2.7 times sales and 11.7 times adjusted EBITDA. That represents about a 40% disconnect in terms of valuation towards its peers. So following a series of strategic initiatives that resulted in some short-term headwinds for the company, but it did help them fix their focus towards more mission-critical solutions. Haivision's set to return to double-digit growth over the next couple of years. So for our fiscal 26 estimates, they currently imply about 14% revenue growth for fiscal 26, and we expect adjusted EBITDA to 2x from compared to 2025. And this growth is predominantly going to be driven through synergies that they're realizing through their recent acquisitions of Cinemassive and AviWest. They're going to experience growth within their existing customer base by offering new products. There's also a transition for cloud and SaaS. We're expecting recurring revenues to climb up towards the 30% mark. They're currently at about the 20% mark. And we also think that there's strong M&A potential for the company moving forward. So just in terms of the strategic transition that has been completed, They exited some of their lower margin managed services businesses. That included the House of Worship market that represented about $10 million of revenue. They also shifted their control room strategy. So they moved away from being a systems integrator where it bundled third-party products such as displays and cables, and now they're operating purely as a manufacturer. So now channel partners handle third-party products, allowing Haivision to focus on their proprietary hardware. This allows them to maintain an asset-light model, and we would expect CapEx to remain flat. Overall, these initiatives reflect a transition towards a higher margin, more scalable business that enhances long-term profitability and their competitive positioning overall. With their Q3 results that they reported a couple weeks ago, they do have an October fiscal year end. We believe the Q3 results reflected an inflection point. The company returned to double-digit revenue growth. There was solid recurring revenue expansion, and they did stabilize their OpEx, which resulted in a return to double-digit EBITDA margins. They just surpassed the 10% mark with the last quarter. So revenue has now surpassed the levels from last year, which included revenue from third-party products. So we do believe the transition has been successfully completed through those results. And as I discussed a little bit before, we're confident in the company's ability to scale up to 20% adjusted EBITDA margins. We do believe that is achievable once they hit the $160 million top line mark. We currently have them modeled at $150 million for fiscal 26, so we're optimistic that we would see that through fiscal 27. Just wanted to talk a little bit about the recent acquisitions that they made and the synergies that they've derived since. So in 2021, they acquired Cinemassive. Cinemassive strengthened their capabilities in real-time mission-critical solutions, and this expanded new opportunities for the company. They've since renamed this division to Haivision MCS, but Cinemassive was largely a systems integrator with technology for the control room space, and they were selling their proprietary products there, which helped with content across rooms, displays, applications, and third-party products. They've since removed that, and Haivision is now focused on their proprietary manufacturing, and they've removed themselves from the third-party products. So some of the synergies that they're starting to realize from the transaction, this led to a significant contract win with the U.S. Navy. It was about an $82 million contract over 5 years. The company is expected to ramp this up through fiscal 27, with fiscal 26 representing the first year of production in the contract. Just in terms of the contract itself, it's a production agreement with the U.S. Navy. It's the NAVSEA program, and it's built on the ongoing success of the recent Canes program, where Haivision's video encoding and playback plays a crucial role in ship-wide video distribution. We do believe there's potential to expand within this business line, and we're hopeful of additional opportunities within the military moving forward. And then just from the Aviwest acquisition, this was completed in April 2022. They had wireless contribution systems that worked well with Haivision's wired contribution system. It expanded their product offering, and now they're able to offer both wired and wireless contribution. This expanded their portfolio of IP video wide contribution. So they're able to offer high-value products towards the broadcast, sports, and live events, which is a growing market. The company was predominantly in Europe. We do believe this has expansion potential, as they were only deriving about 10% of their revenue from the United States. Haivision has a good footprint in the United States. We would expect expansion through here. And the company also recently announced a major contract win with a Tier 1 customer that was brought on through the Aviwest acquisition. Basically, they're transitioning their entire electronic news gathering fleet, and we believe that this could potentially be the first domino to fall within the broadcasting space, and we're optimistic on hearing some upcoming news on contract wins there. Some quick additional growth drivers. So I spoke on it briefly before. Growth in the existing customer base. So customers often start with limited deployments. Haivision is increasing their overall capacity in the products that they offer, so we would expect them to offer more complementary products towards the entire infrastructure. In terms of cloud and SaaS transition, they are deploying more products in this line. Like I said, it's about they're about 20% recurring revenues through this line. We're expecting that to climb up to about the 30% mark. And then M&A potential. So they've got a strong track record. They've acquired 8 companies to date. At current valuation, we do expect them to focus more on share buybacks. I have a little bit of the information up there just in terms of how much they've bought recently. But we do believe that as this story re-rates, they will start looking to the market towards more M&A. And that'll be it for that one. Second pick, I was too excited, so I had to go with 2. My next one is Major Drilling. So they're the world's leading provider of specialized drilling services in the metals and mining industry. They currently operate in about 20 countries across 6 continents. They've got over 700 rigs in their fleet. I believe it's 709 at the end of last quarter. In terms of customer exposure, they're about 92% across seniors and intermediates, 8% exposure to juniors. We would expect the juniors to climb up through the recent financings. We will discuss that a little bit more in a second. In terms of commodity exposure, they're about 41% gold, 34% copper, 14% other, so specialized metals, and then 11% iron ore. Currently trading at about 8 times EBITDA and 23 times earnings based on our fiscal 27 estimates. So just in terms of our thesis overview, I am running a little bit tight on time, so I'm just gonna. We think it's a great way for investors to get exposure to commodities without taking risk on a singular project or a commodity. We are very favorable in the company. They are the leader in the space, and they also have phenomenal commodity exposure, about 75% between gold and copper. When we look at senior exploration budgets, they're up about 20% year over year for this calendar year. We expect it to be back half weighted, so we would expect the upcoming results to be pretty promising. And just on the talk of exploration budgets, they were set at around $2,600 gold. Gold's up about 60% since, minus today's decline. And basically, we would expect more exploration budgets to increase through fiscal 26. So in terms of some of the industry data points that we've been looking at, I touched on it earlier. They've got about 8% exposure to juniors. We do expect this to climb up over the coming quarters. So what we've been seeing on our end, I use the TSXV as a proxy for Canada. Basically, year-to-date, financings are up 40% year over year. It's the highest level we've seen since 2021. It's just lagging it by a little bit. And then when we look at TSX, ASX, and LSE financings for junior and intermediate financings, we're also seeing the highest levels in total financings for up until 2021. And with gold financings, it's the highest level we've seen since we began tracking in 2014. So just in terms of the numbers, it's up about 93% year over year for total financings, and then 130% plus year over year for the gold financings. So as these financings start coming through, it's typically a 6 to 8 month lag from capital deployment towards drills hitting the ground. So we're optimistic with what we're seeing from the underlying data towards the next 6 to 8 months being promising in terms of rig utilization picking up. Another part of our thesis focuses on drilling just flat out underperforming its peers. So we take a group of various commodity classes looking at both producers and non-producers. On average, these groups are about up 161% year to date. The guys that are core to their operations, the drillers, or MDI specifically, they're up about 68% year to date. So we do think a catch-up trade is more than available for the company. And then just in terms of upside potential, so one thing I like to look at is obviously what would happen if utilization rates pick up. So assuming a 60% utilization rate, these levels were achieved during the last upcycle, call it from before 2012. If they were to, and their revenue per utilized rig has been continually increasing. So if we assume $2.8 million per utilized rig and a 60% utilization rate, revenues could surpass $1.1 billion. And then during the last upcycle, we saw EBITDA margins around 20%, earnings margins around 11%. So if we imply similar metrics, we would get about $236 million of EBITDA and about $1.62 on EPS. And then trading, if it was to hit those metrics, it would currently be trading at about 5 times EBITDA and 9 times earnings. If we were to use our historical MDI's historically traded at a 7 times EBITDA multiple. So if we were to use that, that would imply a $20 stock price. But if we were to use the 12 times multiple that we're currently using, that would actually yield a $35 stock price. And that's it for me.